Hey everyone, this is Addy again. Today's topic idea is to learn about how to trade the wheel strategy in the most liquid underlying ticker, which is the SPY ticker, which is the ETF for the SPX or the S&P 500 index. I've written a full complete blog on my website. Go check it out. It's called the longshotidea.com/blog, and then check out this one. Let's go through the whole mechanics of how to trade the wheel strategy with consistent income and where are the risks in the strategy. Now there are risks. Don't get me wrong. This is one of the more popular ones, popular strategy with the beginner traders, especially on the retail side of things. But it comes with a lot of risks. So I want to cover the whole mechanics of it and how to adjust for those risks and how to keep an eye on everything that's going on in this strategy. So let's get into it right away. Now we'll first go through some theory and then I'll take you to the platform and then I'll show you exactly how the numbers work, where to click, which strike to select, how to click that button, right click, sell, whatever we have to do to get into this trade. I will show you exactly how it's done on the platform. So first of all, the mechanics of the wheel strategy, what it is actually. It is basically selling a put and then selling a call. So first we sell a put to acquire the stock position. And then once we have that position, then we sell a call on it. Now I wrote this yesterday when SPY was trading around 596. So that's why the current price is 596 here. But I think the markets are flat this morning. So the numbers should still make sense. And even if they do not, then this is just theory. We'll go to the platform to look at the whole practical example. Okay, the next step. So instead of just going out and buying 100 shares of something, we will sell a put option to acquire that position based on the price that we want. So the strike that we will select is where we will get assigned that lot of 100 shares. That's the whole idea. Instead of just buying the market right now, wherever the market is trading, we can actually take a look at the market here, wherever SPY is trading, and then see how the numbers are different from when I did it last night or yesterday. Anyway, it's loading up, so there's no point there. Actually, it's there. Let's look at it. SPY, the S&P 500 index ticker. Okay, it's trading at 597, so pretty close. So when it's trading at 597, and my numbers are start from 596, so it's very, very close. So you can just take all the reference from here and then apply it to the platform as well. So let's go into, so like I said, instead of just hitting the ask side of it and getting 100 shares or buying 100 shares here, because one option contract controls 100 shares. Now this strategy is done based on 100 share increments. That's how I do it. You can do it on less numbers as well, but then the platform will charge you the margin accordingly. So when I say margin accordingly, that means when you don't have the full allocation of 100 shares and you're still trying to sell a call on it or sell, do something with it, it will charge you for the difference. And I'll show you that later on the platform. But let's go through some theory first. Okay, step by step. First thing we do is we sell a put option. Now, I would go out and sell it at 45 days expiration. That's my go-to. That's my sweet spot. I like that because I get enough premium. I don't have to worry about the trade too much. I only look at it for like 5, 10, 15 minutes a day. And then I don't really need to do much with it. Now, you also need to make sure that you have enough money in your account to start this wheeling strategy. You can do it without the money, but then again, the platform will charge you margin. But if you have enough cash, for example, you are sitting with $58,000 or $60,000 in your account, right? And you want to acquire 100 shares of SPY. This is what I would do if I was in your position. Okay, I will go into the July 18 cycle, and I will go back to like 580 put. Okay, why 580? Now let's first select the right cycle. We are in SPY. I'm going to go to 43 days out. I did it yesterday, which was 44, so that's pretty good. Okay, I will look at the volume and I will look at the open interest column, which is here. Volume and open interest. Look at how both of these numbers are in thousands, right? I mean, volume is a little low because the markets are flat. There's not much going on in the market right now, but the open interest, meaning the current open contracts on these strikes, are in thousands. Very liquid market. And if you look at it, the majority of it is sitting between this block. So 52,000 starting here and then going all the way down to 430. So this is where people think that most of the risk is. So they've bought protection here. Now, don't get me wrong, I don't know whether they've bought these puts or they've sold these puts, but usually in these main markets or main indices, people buy puts. And therefore there is a put skew in these major indices, especially S&P 500. What I mean by put skew is because people buy a lot of protection, look at these open interest, they end up bidding up the price of the put. And therefore the put side is more expensive, which means for sellers like us, option sellers, we get juicier premium selling the put versus selling the call, which is equidistant from the at the money strike. That's the whole idea about the skew. Now, if you were to take a position, look at this, 430, the delta is 1, not even 1, 0.01, right? I would not sell this because there's not enough credit here. You're only collecting 27 cents. So our sweet spot is 44 days out, 43 days out right now, and then select the 17 delta strike. Where's 17 delta? It's right here, 560. Actually, for this kind of strategy, I selected 580, so let's just stick to that because that matches the theory more. But if I was doing this in my real account, I would select a little bit further out, around 20 delta. So I would select around 570. 21 delta is totally fine with me. I would select 570, but in order to match the theory or the blog, we'll select the 580 and then see how that goes. So today we are collecting 665. When I was doing this yesterday, I was collecting at least $7. So the premium has come in a little bit, meaning if you had sold this put option yesterday, we would have made 7 cents, and 7 cents means $7 in options world. Okay, so what would I do? I would go right click here on 580, right? And I will sell a single. I will sell a single, okay? Take this out to 1. Go back down to 1. Not 0, 1. Okay, so I'm collecting $6.58. Totally fine with me. And then look at the confirm and send. Oh, I need to show you the chart as well. So look, the buying power effect is 57,340, which is basically your strike price minus the credit that you're collecting times 100. So your strike price is 580. Your strike price is 580. You're collecting 6.59 something. That's $573, and that's what this number is, 573.40. You multiply this by 100, and that's your buying power effect. Okay, so now you know exactly what how the buying power effect works in a single leg option if you're just selling the put side. Okay, so that's your buying power effect. Now the net collection is basically the amount of credit that you collect minus the per contract commission that you pay to the platform. I pay 65 cents. Everyone pays different, I think. This is where I've been set. I've tried to lower this with Thinkorswim. It doesn't work. So this is where I'm set. Okay, so right click and analyze this trade first. I do apologize. Okay, let's take a look and then change our break evens and look at the whole picture here. So I'm going to go 719 here, 719 on top here, which is totally fine. It is all set up. I have a 74% chance of making money on this trade. Now, the way I will get a sign on this one is only if the stock goes below my strike price, which is 580 by expiration. Let's say it's sitting at 560. I will still get the stock at 580. Right? Once I have the stock at 580, I am now the owner of 100 shares of SPY at a cost basis of 580 minus the credit that I collected. So 580 minus $6.60. My cost basis is $573.40. That's my cost basis. That's the number I need to have in mind before I do anything on the call side. Okay. So similarly here, I was collecting 7. 580 minus 7 is 573. And I've just shown you where to look for the puts and where to look for the calls and which expiration cycle. If you enlarge this picture, you'll see that I was in 44 days cycle yesterday. Okay, the put strike that I was getting at 30 or 20 delta somewhere, 30 delta, I think I was getting, and I was collecting $7. Now assignment happened. We've already talked about it. That let's say you get assigned at 580 strike, which means now your cost basis is 573. Okay, so you need to keep that in mind. That you have purchased 100 shares of SPY by paying 573 a piece, meaning $573 for one share. Times that by 100, and that's your total net out-of-pocket cost to acquire this. There's no cost to acquire the shares, but there is a cost to put up a option position. So when we sold a put, we paid 65 cents. Same thing on the call side. When we will sell the call side, we will pay another 65 cents. Okay, now you have the shares. Now what do you do with it? Okay, so then you go onto the call side, right? You go on the call side, select the same. Now this time I was selecting the August 15 cycle. Okay, so now let's say in 30 days from now, or 40 days from now, you got assigned. So then you have to select the August cycle now, which is currently 71 days out, but in 30 days, it will be another 40 days out, okay? So that's the sweet spot one more time. I will go out and I will select the 20 delta. Whatever the 20 delta strike is at the time, I will select between 17 and 20. That will be my sweet spot. So yesterday I selected 610. Let's stick to that. But in reality, I would have stuck around 20 delta, okay? Okay, so at 610, I was collecting 625. I've made a note here as well. So if you were selling it at 610 yesterday, you would have collected 625. So now you have collected two premiums, one on the put side, one on the call side, okay? What is the risk? We didn't talk about the risk on the put side. What was the risk on the put side is, it's the initial position that you're trying to put on. No risk there on the initial trade. However, once you get assigned, let's say at 520, and then the stock keeps falling down, and it's now trading at 550 or 510 or 520, whatever, right? The problem is, if it goes too far below your strike of 580 or your cost basis of 573, you need to keep your cost basis in mind. So let's say the stock goes below 573, then you will struggle to sell the call side of it and get enough premium on it, because now the call side is not too far away, not far enough away for you to make money on the upside of the stock. The stock is trading at 570, 573, and maybe the max you could get from there would be 600 strike, not 610 like I chose yesterday. So 600 strike would be your best option when the stock is trading at 573. 573 will be somewhere around this mark here, right? And then you will collect 600. In my case, yesterday I was collecting 610. So here's the risk. Currently we're thinking about the stock going down to 573. It can easily go down below 540 as well, 550, 510, 500. Now, when it goes below your cost basis or your effective cost basis, which was 573, then you need to figure out where to sell the call side to get enough upside on the stock from 573 and collect enough premium. So if the stock is trading at 520, I highly doubt that you will go anywhere beyond 550 to sell enough credit on the call side. So you will not do anything, okay? You will wait for the market to jump back up again towards your cost basis or slightly above that. Then you will think about selling the call side. Otherwise, you will just sit on it. You have taken assignment, you will sit on it. It's fine. So you are out of pocket $58,000. That's totally fine because you decided to do this, right? That's why I say you have to have that money allocated to this position if you are doing a wheel strategy. So you are assigned. The stock is now gone below your cost basis, further below. Well, going below your cost basis is totally fine. It cannot go too far below your cost basis because then at that point you do not get enough credit on the call side, right? But if you're willing to let the stock go, let's say it's trading at 550, your cost basis is 570. You are willing to let the stock go at 575 or 580, you will still sell that call. Wherever you are comfortable letting the stock go, you will sell the call at that point. If it's trading at 500, you don't want to let the stock go at 550 because your cost basis is higher. It is at 570. So you will not sell anything at 550, 560, anywhere below 573 does not make sense to you, right? So you need to make your mind up that if it goes below your cost basis further down, you need to sit on it a little bit so it jumps back up again. So long that you are comfortable selling anything above 573 cost basis. If you're willing to take that $2 upside, you will sell it at 575. If you're willing to take the $7 upside from 573, you will sell at 580. So however much you are willing to take on the upside, you will sell the call on that strike. That's the risk here. If it goes below, you gotta wait on it. You gotta keep waiting, sit on it, and then make a decision. Okay. The next step, like I mentioned, is the call side. Now you've collected two premiums. So you've collected the put side and you've collected the call side. Okay. Once you sell the call side, now you have two premiums. So your cost basis is lower even further. You've collected 700 and 625. Now, however much you actually take home from that is a different story. But let's say you take $10 home. From $13, you take $10 in your pocket. Okay. So from 573, you need to reduce it by even further. So let's say by $3 or $4, because you're probably taking home maybe $3 or $4 from here, $4 or $5 or $6 from here. So total you're taking $10 or $11. Okay. So from 580, your cost basis is now 570, 569. That's your net cost basis. You need to keep that in mind. Okay. So anywhere above 570, 580, 590, 600, wherever you're comfortable, you will sell. Keep selling that upside. If it doesn't get called away from you, you will keep selling that upside, and then your net profit will be here. I've got the net profit thing as well. So you sold it at 610, it gets called away. Let's say, for example, it gets called away. Your first cost basis was 573. Your next one is 610 that you sold it at, right? And then it gets called away. So all the upside from 573 to 610 is your upside. Plus you collected two premiums. So that's $1,300. So the net total return is $5,000 on this one trade. You put down how much? $58,000. You collected $5,000, right? So that's 8.6 return. That's how I get to the 8.7 to 10%, right? That's your net ROI. Now, let's say the shares do not get called away. You are still sitting with the shares, and then the call expires. So you collected two premiums, plus you got some dividend on it. You dividend, SPY pays dividend. If this whole process takes 3 months, SPY pays quarterly dividends. Now, I'm not sure about the yield. I think it's at 1.7 to 2%, maybe slightly higher. You collect that 2%, 2.3%, whatever that monthly yield is. So that's how you will make money if the call expires and it doesn't get called away. Okay, a little bit on the downside protection. You sold the put. Now you don't want the stock to go further down on you. So you will buy a put at a break even. Your break even is 573. We already know that. Your cost basis is 573. We will go and buy at 1 standard deviation support level to buy a put if you wanted to buy a put. I would not do that. I've just put this here because I'm going into the strategy with the mindset that I am going to spend $58,000 to hold 100 shares, and I'll collect some money. And then if it goes below me, I'm going to keep holding it. Totally fine. But if I ever want to get some protection from it falling further, so let's say I'm buying it at 540. Now look, I'm buying a protective put at 544. Like I mentioned before, if it keeps falling, that's not a good thing for you. It has to be stable, or it has to be jumping up a little bit. But if it does fall from 573, your cost basis, and you've bought a put at 544, it gives you an additional 5.1% downside buffer, meaning if the market falls by 5.1%, you are still covered. Okay. Now, I'm not taking into account the premium that you will pay for the put. It might be like from 5.1 to basically your total protection will be around 4%. So, including the debit. So, if you think the market is going to keep falling, you only want to buy a put, I would buy it at 4 to 5% out of the money from my cost basis, so that I'm covered with a 5% drop in the market. Okay. Oh, very quickly, I just want to show you how I can help you with all this. So I've been trading options for the last 10 years with some good consistent income in the last 3 or 4. Initially, years were not good. but last year 4 years have been really, really good. I've perfected a few strategies which I would like to show you and help you out with. If you've been buying options in the market and not being very consistent and profitable, maybe you want to try selling options, which is what I do. So I run a free live masterclass every 2 weeks. The next one is on June 13th at 3 p.m. Pacific on Friday. Um, Go on this link, sign up here. You just need your name and email address. And things that I will cover in that class are all listed here on the website. Okay, I will put the website address in the show notes so you can take a quick look at it. But we will be covering some of the mistakes that people make, initial traders, beginner traders, and how to actually do the trades correctly. How to manage, how to adjust, how to roll, which we are also going to discuss in the remaining part of our today's video. But the whole idea of that webinar is to get you a good feeling about what I can help you with with my trading experience. I've been in the finance world, the investment world. I am CFA level 2 cleared. I just need to clear the level 3 part, and I'm not getting enough time to read about it. So, I am there. I've been through the tough times. So I think I can help you out with your trading journey. So take a look here and then see if you want to sign up. I do also run a 5-day complete trading cohort challenge. This is a paid service, but you will learn exactly how I go on about things in a very detailed way. And we do deep dives every day. It is designed for beginners and intermediate traders and even advanced traders to come and join us and look at all the strategies that we do, right? Everything in a lot of detail, a lot of homework, and then just to get you going. Now, can I make you a perfect trader in 5 days? No, I cannot. But I can get you going. I can get you started. I can get you a good feel about the market and not take any emotional and panicky moves in this market. Anyway, let's get back to this advanced adjustment example. Now, SPY drops to 575 from your current price. We will roll the put. If it goes down below too much, I can even roll. This is an option, right? With options, you always have an option. So if it goes too far below, I will roll the put into the next cycle, and I'm still net. I am still credit, meaning I'm still taking home $5.50 home, meaning I buy back the 580 put, okay, at $12. Let's say I sold it at 7. I'm buying it back at 12. That's a $5 loss. But I'm selling the further strike out in the August cycle at 575 or somewhere even below that. So I'm collecting more credit. So net, I am still positive, okay? Now my break even becomes 562 because now I've collected more credit. Whenever you collect more credit, your break even goes further and further out, okay? Meaning you get a better and a bigger range for the stock to stay within it for you to make money. With a narrow range, with less credit, and if you're paying a debit, your break evens get narrower and narrower. But with credits, you widen out your break even points. Now I'm showing you both sides, which is how this triangle works, right? A very good strategy. Credit spreads work the same way. Iron condor works the same way. But here you have one single side on the short put side. Once you collect more and more credit, your break even goes further and further beyond, meaning you have more room to be wrong and still make money. Okay. I've already talked about these returns. You can just go take a look at these numbers again. There's obviously more drawdown risk in the in the buy and hold strategy. Monthly income I just showed you $1,300 you can collect by selling both sides. Now, there's one caveat here. It may not be monthly income, but it could be 2-month income or 1.5 month income because we're selling every 45 days. Okay, it might take a month for premium to come in, so that's 30 days, and then you will sell another 45 days, another 30 days to come in, so that's 2 monthly cycles. Okay, sorry about that. So again, look at these break evens. If you have any questions on these numbers, just let me know. I did not show you the call side, right? So let's say we got a sign on the put side. Now we're trying to trade the call side. Again, look at the open interest and volume numbers. I think I showed you 610 we were selling at in July. But if it falls, then I can also go into the August cycle and roll up my put until I get assigned. Once I'm assigned, I'm going to go out and sell the call side. I've already talked about when the stock goes below or through your short put or your cost basis on the put side, right? That's when the risk comes in. But there's nothing to panic because you can either roll the put and don't take assignment. You roll it at a buyback at a loss, sell it another one in the next cycle, right? 4 or 5% out of your cost basis again. Not cost basis, but whatever the stock is trading, you go 4 or 5, 10% even further down. Take a net credit. Net credit means you widen your strikes, widen your break evens, so you have more room. Okay, exit rules. If nothing happens, no assignment, nothing, I'll still take short put. If it's in 50% and I don't want to get assigned and I want to repeat the cycle, I'll close it at 50 to 60% and I'll go home, I'll take it home and then I'll go, recenter my strikes, redo it, start the whole journey again. And if it breaches your short put, like I said, it keeps going down, you can roll the put option too. Or you can buy a put protection. So I've shown you three examples of managing this trade. You buy a put somewhere below your cost basis, okay? You can roll the put somewhere further out in cycle and collect credit. Collecting a credit is the important thing because that widens out the break even, okay? Or you can close it out, sit on it, let it move, let it go further down and, hit the support level somewhere and then sell another put option, okay? Those are the options we have. That's all I had for this strategy. On the call side, if it gets called away, now you're done. You got a sign on the put side. You got called away on the call side. You're done. You made some money in the middle, paid some commission, and that's it. And then you rinse and repeat. So maybe I think you can do this trade maybe 3 to 4 times a year. And then annualize your returns and then see. Maybe you are making we can make 15 to 20% annualized on just this strategy, okay? The wheel strategy. So I hope you like it. If you do, please subscribe to my channel. It all helps. And then I'll see you on the other side. Thank you very much.